Hello, everyone. This is Anthony Valeri, Director of Investment Management in our Wealth and Fiduciary Services Department. Thanks for joining our latest webinar talking about ongoing developments in the economy and financial markets. Today, talking about the stock market and economy disconnect. Why have stocks bounced back so strongly when economic data has been so poor? We'll get into that and go into detail as to why. So just a quick summary of where we stand today and what we plan to cover in today's call. First, several economic data points: weekly jobless claims, monthly employment, retail sales, industrial production, housing starts, even core CPI. Some of those have produced their worst monthly changes on record. We're talking about 70 years worth of data in some cases, sometimes more, where they produced their worst data point on record. Just some shockingly bad economic data. That's probably going to be highlighted by second quarter economic growth, which, as measured by GDP, is expected to fall 33% at an annualized rate. We won't get that data until late July, and the expectations are still falling slightly, but that is a shocking number. It would make it the largest quarterly decline on record. And then in terms of corporate profits, which are really specific or important for stocks, after declining 12% during the first quarter of 2020, profits are expected to decline by 42% in the second quarter. So a big drop following the decline in the economy. And while they're related, you're seeing stocks up 30% from the March 23 low. So really, what gives and what's driving it? And I'd like to approach this from two different angles. One, from the differences between the stock market and the economy, and then second, from some nuance that is happening within the equity market or stock market itself. So why don't we go ahead and get started? First, let's talk about the concept, and one that I've used throughout my career is that S&P is not GDP. There are differences between the stock market and the economy. And yes, over long periods of time, I'm talking 10 years plus, they do move together. GDP, as it expands, creates revenue and profits for company, which fuel stock prices. But there are some important differences that can lead to disparities over a shorter horizon. So first, keep in mind the U.S. economy is all domestic, whereas the S&P 500 stock index, almost 50% of revenue is derived from international operations, and that has gradually increased over the last several years. Consumer spending drives 70% of the U.S. economy, but for the stock market, it's only 18% of S&P 500 profits. Manufacturing, a little more of a subtle difference here, responsible for 29% of GDP, whereas it drives about 45% of revenues for S&P 500 companies. And then on another note, the economy benefits from a strong U.S. dollar, but then on the stock market benefits from a weaker U.S. dollar, due again to that international exposure. So less important on that last one, but again, there are some differences to behold. And I should note that that international aspect is important because over the last 2 decades, globalization and a greater share of international revenue has really started to create a disparity between the stock market and domestic economic growth. So some important subtleties to realize that these are two different things as we think about the economy and the stock market. Now, one case in point here is regarding a couple dynamics regarding the economy and the stock market. So stock markets are forward-looking mechanisms that anticipate cash flows and profits over a multi-year time frame. When you buy a stock, you're not buying it for a 1-year hold, you're buying it for 3, 5, 10 years, well into the future. Whereas economic growth is usually a point in time backward-looking measure. Some data points are lagging, some coincident, and then a smaller subset are truly leading. The monthly employment data is considered a lagging indicator, which is more of a rear view mirror snapshot of the economy. And just to show you that point with data, since 1975, the U.S. economy has lost 200,000 or more jobs on 43 separate occasions. That's using monthly data from the Bureau of Labor Statistics. However, despite that bad data, the S&P 500 has returned 17.1% on average over the subsequent 12-month period that week monthly jobs report was reported. Not only was it that high in average return, but it was positive 84% of the time. So that speaks to the sort of forward-looking aspect of the stock market. Usually it anticipates a rebound, as has often been the case when the economy comes out of recession. So some very strong stat in terms of one, stock market performance, and also the high batting average of 84% success rate over that 12-month time frame. And that also tells you it's been fairly consistent. And let me give you the most recent example. So here is a chart from one of our third-party research providers showing the extent of the rebound. So following the financial crisis in 2008, the S&P 500 bottomed on March 6, 2009. The March payrolls, which were released on April 3rd, was one of the worst on record, showing a loss of 800,000 jobs. Now, payrolls had weakened ahead of that. They started to turn negative much earlier in 2008, but just goes to show you that the worst jobs print occurred in April, and that was 3 weeks after the low. Actually almost more than 3 weeks after the low, and the S&P was up 27% from that low point until that March employment data was released on April 3rd. Not only that, but there were 7 more months of job losses after that bad report. Of course, the market continued to move higher after April and May and continued to go higher from there. So it just goes to show you that the market's bottom before the data really begins to improve. So an interesting example, and there are others throughout history where some of that employment data is terrible, but the markets have bottomed ahead of that. So again, stock's a forward-looking mechanism. Often by the time the data is still poor, it's moving higher. So a couple data points looking backwards on the employment report, but really what the market is focusing on is some of the just initial signs of improvement. And it's interesting in this cycle that data has taken on a different form, not some of the traditional economic reports you hear about in the media, but stuff like visitors, mobility data, cell phone tracking information. For example, looking at visits to retailers based on cell phones, you can see that has improved in May. And although it's still down over 30%, and which means we still have a long way to go, but it's that initial improvement that the stock market is focusing on, which basically says things are returning to normal. Even if slowly, this is a first start of returning to normal. You can see that in other indicators too. So weekly average supply of fuel to gas stations has been slowly creeping up. Again, still down 17% from the pre-crisis weekly average. And then if you look at more timely data on retail sales, the Johnson Redbook data, retail sales or same-store sales are down 7.5% from a year ago. Just the prior week, they were down over 9% from a year ago. So there is just those initial signs of improvement as economies begin to reopen, not just in the US, but globally as well. But these are some of the initial signs that have been fueling this rebound in the stock market. Again, stock market looking forward that these initial signs will translate into a return to normal. So long way to go, but these are just some of the alternative or more frequent timely data points that are a better gauge of the future economy. Now, one more mobility report to show you the progress, and this includes some global data, is the amount of driving route requests that users of the iPhone have input. And you can see the steady improvement from late March or even early April for a few countries. Germany, which reopens, one of the first to reopen in April, has seen a steady improvement. So has the US. We're starting to get traffic back to normal levels. And you can see even hard-hit Italy is seeing a return. Still more to go to get more of a return to a baseline data level. But again, this is yet another data point showing improvement on a more timely level. And then finally, the hardest hit area, travel and restaurants. We're starting to see improvement there. Here, focusing on restaurants. And if you look at open table data, which shows the number of restaurant reservations for in-restaurant service in the US, it dropped to 100, meaning that there was no visits to restaurants for quite a period of time. It is still near bottom here, down 93%, but that improvement from down 100% to down 93 is helping to drive signs of life in the economy and a return to normal. Again, a long way to go, but you're starting to see it. And more notably, you're starting to see it in some of the states that reopened first. So Georgia was the first state to really move forward with the reopening on April 24th. On May 1st, Tennessee, Texas, and Oklahoma also reopened. And you can see that the improvement in terms of restaurant seating is a little more pronounced among these states. So again, you're starting to see this is sort of the leading edge of the economy reopening. And more importantly, these states have reopened without seeing a substantial increase in virus cases. In other words, virus transmission has stayed very low. There has not been a resurgence despite 3 weeks of reopening. Still early, but again, this is what the stock market is focusing on in pricing in essentially a return to normal. So at the margin, seeing multiple signs of life and a return to normalization in the economy, and the stock market as a forward-looking mechanism is moving to price that in. Now, before we move too much further, it's really important to highlight, as I've done on prior webinars, just the unprecedented response, and that word unprecedented has been used a lot in recent weeks. That response from both Congress and the Fed is a big driver as well. And this shows federal tax spending, and you can see how robust the government has been in addressing the impact from the coronavirus. You can see tax revenues falling as unemployment rises, but again, that surge in spending more than makes up for that, and is not by itself is not going to engineer a rebound, but it does buy time for the economy to heal and improve. So this lessens the blow and buys some time to improve. So the government has had a very strong response, and that's helping to put a floor, I think, in markets, as is the Fed, and the fact that they have been more aggressive than they were in 2008. The Fed's balance sheet is ratcheting up higher. It's almost $7 trillion following an aggressive bond purchase program, and also the various lending programs that they have in place. So just an impressive amount of money being put forward by both the Fed and Congress to help address this situation. And those are key supports as the stock market has been moving higher. Now let's take a little closer look into nuanced data for the stock market that is driving it. And I'm going to take a little bit of a stock 101 or finance 101 example here. So why aren't stocks down more, even with those signs? They're still very early and really need to play out for a longer period of time. And it just goes back to a little bit of that forward-looking mechanism and the fact that when you invest in equities, you're really buying into a long-term stream of cash flow. So let me put forward an example here to walk through that. Assume a company earns $1 today in earnings, and those earnings grow at 6.5% for 20 years. And that 6.5% growth rate is the long-term historic average growth rate for corporate earnings. If you just use a simple net present value calculation, that company is worth $17.63 today. If earnings drop 50% in the following year as response to the recession, but then bounce back to normal after 1 year, that value of that company drops to $15.29, or by 13%. Now, if you assume a more severe hit, earnings drop by 50%, but it takes 2 years to get back to normal instead of 1, then the value of that company falls to $14.29, or a decline of 19%. The real takeaway here is that earnings in 2020 are expected to decline 20 to 30%, but stock values at least from the top, are down less than that. And the reason why stock values drop less than the decline in earnings is because investors anticipate earnings in the future into the current price of stock. So you'll never see stocks, or typically won't see stocks drop 1 for 1 with earnings declines. It's because they are pricing in a return to higher earnings in the future. So just a simplistic example of how we see stocks react to a decline in corporate profits. And corporate profits really are the key if you are a stock investor, more so than the economy or GDP. And we'll go more into earnings here in just a moment. On a short-term basis, and I stress short-term, investor positioning is still very defensive. This is the latest global fund manager survey of how global or institutional investors are positioned, and it reflects whether they are overweight or underweight various sectors and geographical investments across the globe for the equity markets, and also for bonds and cash. So the overweights, there are some notable ones you'll see here. Investor positioning is still very defensive. The biggest overweights are healthcare, cash, and bonds. Consumer staples, one of the more conservative investments in the stock market, also a significant overweight, as are utilities, which I didn't highlight there again. So you've some of your most defensive positioned sectors are the big overweights for investors. And you can see down at the bottom, equities are a significant underweight. So when you have that sort of defensive positioning, it actually is contrarian in nature and can provide short-term support for the stock market. There are other measures of this. There's the current data showing the amount of speculative bets for stock market to go down are also very, very high. That too is a contrarian indicator that can often provide short-term support. For on a short-term basis, then in addition to what we've discussed on sort of a long-term basis, this is providing additional support to the stock market. Again, this could change, but these are some of the drivers. Now, going back to some of the nuance in the stock market, and I want to take a closer look at some dynamics, which will also help explain the resilience in the stock market. When you look at the 11 sectors in the S&P 500, it's really a tale of two halves, the haves and have-nots. And first quarter earnings season is essentially complete, and four sectors accounted for the bulk of earnings weakness: consumer discretionary, which is where you're going to see your spending, energy, financials, and industrials. Those four sectors really bore the brunt of first quarter weakness. And then if you look at the a few other sectors, technology, healthcare, communication services, and consumer staples, which are your more, as it sounds, your staples such as your food items and the related necessities, all four of those sectors registered positive earnings growth. In fact, their average earnings growth was 6%. Now, it's important to understand the hardest hit sectors account for 31% of the S&P 500 or the broad stock market, whereas those four sectors that made gains in terms of earnings account for 61% of the stock market. So you're really seeing more than half of the equity market managed to actually not only survive, but actually grow earnings in the first quarter. I think that's going to change for the second quarter. But again, it goes to show you when you look under the hood at the stock market, there are a number of sectors who've continued to just continue to grow and not be impacted by the virus. So that makes this current situation a little bit different. Again, this dynamic should change a little bit in the second quarter. But when you look underneath the hood at the equity market, there are some sectors that are clearly doing better than others, and that's helping to drive resilience in the equity market. Now, the naysayers will say, well, if the five largest companies in the S&P 500 dominate the broad index, and that's driving it. And yes, Microsoft, Apple, Amazon, Alphabet, or Google, and Facebook have certainly been among the more resilient companies in the S&P 500. In fact, the concentration's as great as it's been since the early 70s. But that doesn't account for all of the performance in the stock market. In fact, if you look, again, a little closer at the market, if you look even at the S&P 500 equal weight index, that's actually been one of the best performing indexes. And it just goes to show you that what's a good sign about this rally is that it's been fairly broad-based. So the S&P 500 equal weight up 34%. Small cap stocks, which were really hit hard initially in this sell-off, have also bounced back, particularly over the last couple of weeks, also up about 33%. Same for the Russell 3000, which is a far more broad measure of the equity market relative to the S&P 500. And you see the S&P 500 there. This is through May 15th. And then if you look at the international markets, those have lagged fairly substantially, but still 20% plus gains in both international developed and emerging markets. So you're seeing gains across the board, more so here in the US, but these gains are fairly broad based. Now, there are sectors, again, like financials that haven't bounced back as much, but even hard hit energy has bounced back as well. So there's definitely some broad-based gains here, and I would not dismiss the improvement in the market simply due to concentration. Let's get back to earnings and talk another factor of what's driving the market, and that is that bad news is substantially priced in. So if you're looking at profits and how they drive the stock market, it's important to realize just how sharply those expectations have come down. So the bottom line is 2020 corporate profit estimates, and a big reduction down to essentially $129.16 worth of earnings for the S&P 500. Those forecasts really started to accelerate to the downside in the first and second week of April, and you can see that it is ever so slightly starting to slow and stabilize. And that's what the stock market is focused on. It's that rate of change. It's that stabilization to where the market has priced in a substantial portion of the bad news. Now, it's very possible the earnings forecast could be weaker than that for the full year. But again, it just shows you the significant amount of revision to corporate profits that the market has already accounted for. So that also basically prices in a lot of the negative impact. The big trick is whether these earnings were bounce, not the trick, but the real factor is whether these earnings bounce back to normal. And here's another way to look at it in terms of calendar year earnings growth. This is from FactSet. You can see the big drop expected for 2020. And then for 2021, the market's anticipating, based on these forecasts, a return to normal earnings growth, or essentially matching the level of 2019 earnings after 1 year of decline, which would be that's essentially what's baked into the cake in current stock market prices. This is really the risk that I think is worth watching going forward. Does that second year, 2021, become a return to normal year? And if it's not, then you could see additional downside in the stock market. Essentially, the market has thrown 2020 out the window. They've written it off as a bad year, and are basically focusing on 2021 as a return to normal. So that's a big part of how this rebound has unfolded. I think it's a question mark whether we get back there so fast, but still that has been an underlying driver. And to the extent it does or does not match that, you'll see continued volatility in the market. So it's certainly normal, as we expect more of a choppy sideways market to come as a result of debating that earnings forecast. One piece of news also that's helping is the better news on the virus. Would be remiss without addressing that. In the US, testing has ramped up considerably. That's the dark blue line. So testing is since late April has accelerated quite a bit. And more importantly, the positivity rate, the red line, has come down. So as you test more and more people, the fact that you're not seeing an increase in the positivity rate means that the virus is not as widespread as may have been the case. So that is a piece of good news. And new case growth in the US, about 1.5%, and continues to slowly decline. So a lot of good news on the virus. And of course, the recent news on Moderna's vaccine treatment has been a big driver of fueling improvement in the market, as the market anticipates the development of a vaccine in early 2021, which would really facilitate a return to normal in many lives. So there's still some questions about what the second and third order effects are of the coronavirus pandemic. We'll find out what those are. But again, for the meantime, this is what the stock market is rebounding on. And just to summarize again, the market is a forward-looking mechanism. So while the majority of economic data is a point in time and showing some weakness, the stock market is really focusing, one, on the strong response from the Fed and Congress, which buys time for a rebound, but also some of the more timely data showing light at the end of the tunnel and a return to normal. There are some differences between the economy and the S&P 500, and especially the fact that stock investors usually look for or anticipate several years of profits, not just the impact for one particular year. And again, the focus I think going forward now is the expectations to normal in 2021. As those change, and if they turn for the worse, you could see another renewed decline in the stock market, a return of volatility, a virus resurgence, and another round of lockdowns would really likely spark another down leg in stock markets. But really, I think the low is in the March 23 low, and it could likely to be volatile as the economy tries to reopen here over the coming months. So that hopefully explains the stock market and disconnect. Thanks again for listening. We'll keep you posted with further updates. I'm Anthony Valeri. Thanks for joining.